Okay, so I have a riddle for you. A bit of a counterintuitive one.
Oh, I like riddles.
Yeah, I want you to really clear your mind for this one.
Okay.
Forget everything you learned in Business 101. Forget the standard metrics of the S&P 500, and just picture this scenario for me.
I am ready. Tabula rasa. Blank slate. Hit me.
What if I told you there's a company that is actively, intentionally acting in a way that often reduces its share price?
Reduces it.
Yeah, or at the very least, is behaving in a way that makes the nominal share price, well, almost irrelevant to their internal goals.
Okay, that's already strange.
And here's the kicker. What if I told you that this company could be considered wildly successful, like historically successful, even precisely while it is actively diluting its common stock?
Wow. Okay, that sounds like a paradox.
Right.
Or, frankly, it sounds like some kind of scam.
Exactly. It sounds like financial suicide, doesn't it?
It really does.
In the traditional world, dilution is, it's a dirty word. You dilute, the pie gets cut into smaller slices, the shareholders get angry.
The share price drops, and usually, the CEO gets fired. That's the playbook.
But
yeah,
what if that playbook is just obsolete? Does share price actually count as the ultimate measure of success anymore? Or are we witnessing a total inversion of the market mechanism?
An inversion?
Are we seeing a shift where shareholders stop being speculators and start being something else entirely? Investors in the truest sense. Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi.
Okay.
You are setting the stage for a very specific, and I would argue probably the most controversial case study in modern finance.
You bet I am. Today we were talking about Strategy, Inc.
Of course.
Most of our listeners probably know them by their former name, MicroStrategy.
The enterprise software company that pivoted to become a Bitcoin proxy, a very, very big Bitcoin proxy.
The company that became a Bitcoin refinery. And that's the phrase we are really going to unpack today.
I love that phrase. It's so descriptive.
It is. Because if you just look at the charts, if you look at the last 12 months leading up to today, January 29th, 2026, traditional analysts are calling it a disaster.
Oh, yeah. They're calling it the lost year.
The lost year.
And on the surface, if you are looking at just the fiat price, they have a point. The stock is down significantly from the highs. We've seen massive drawdowns.
But, and this is the whole point, this is the twist, while the stock chart looks like a double black diamond ski slope.
That's a good way to put it.
The Treasury has undergone a massive, almost industrial expansion. It's like looking at a duck on a pond. On the surface, it's calm, maybe even sinking a little bit. Underneath, those feet are paddling like a maniac.
That really raises the fundamental question of this deep dive, doesn't it? Is the market suffering from an optical illusion?
Exactly. And that's what we're getting into. We're going to deconstruct the sailor premium.
A very real phenomenon.
We are going to talk about the infinite money glitch. And yes, that is actually a technical term they use in this context.
They're really staggering.
They are.
We're talking about how Strategy, Inc. managed to increase their Bitcoin per share by over 23%.
In a single year.
In a year where their stock price was literally cut in half.
Think about that for a second. Price cut in half. Value up 23%.
Yeah.
We are going to explore why this might just be, maybe the only rational way to measure corporate performance in the digital age.
It's a fascinating inversion of how we think value creates price. It really challenges the very definition of wealth.
Before we jump into the refinery, I have a very serious, very important request. We love doing these deep dives. We love digging through the piles of research so you don't have to.
It's what we do.
But we have a goal. We are trying to unlock funding for the Mosaic AI video editor.
Right. We want to bring visuals to these conversations. We want to be able to show the charts we're talking about, not just describe them.
Exactly. And you may start calling us broken records on this.
We know.
But we still need to hit 1,000 subscribers to unlock the funding for not only the Mosaic AI video editor, but to really, and we mean it, to really continue the show.
And what does that actually mean?
It means there is no place for deep research in popular media. It just isn't supported. We truly don't want that reality, do you?
Absolutely not. We want depth, not just sound bites.
So please, if you're listening, hit that subscribe button wherever you are. YouTube Music, Apple, Spotify, Fountain.fm.
And we do love Fountain.
You can send us tips.
Yeah.
Like 1 cent. I'm serious. In this day and age, for a small creative team, setting 1 cent, even a penny, is a huge announcement of your support.
It really is. It says you're listening and you care.
But hey, thank you bigly for your support. Penny or dime aside, it is your attention that keeps us going.
And we will keep going.
Now, one last bit of housekeeping before we get to the Bitcoin talk. We usually preach safety here. You know us. We are the STRC guys. Safe, tax-free, reliable cash.
Our background is accounting. We like fixed income. We like sleeping at night without checking our phones every 5 minutes.
Exactly. Speculative tech stocks usually give us nightmares.
They really do.
And that is exactly why we avoided MSTR for so long. It felt volatile. It felt risky.
It looked like a casino from the outside.
Right. But the more we looked at the sources for this deep dive, the more we realized this isn't just speculation. It's a paradigm shift.
It's a different structural approach to finance. It's actually closer to banking than it is to software in a weird way.
I think you're right. However, if you are listening to this and thinking, guys, I just want safe, boring income, please check the link in the description.
We've got you covered.
We have a free course on YouTube. It's a collection of our finest audio-only deep dives on high-yield, safe, tax-deferred investments.
Perfect for walking the dog or going for a run.
It is. But mind you, the course is only on YouTube. And that's because YouTube lets us choose select deep dives and put them in a course. But today
is different.
Today we are walking on the wild side. Today we enter the refinery.
Let's open the books.
Okay, let's start with this lost year narrative. We're sitting here in January 2026. If I am a typical Wall Street analyst at a big bank sitting in my glass tower, and I pull up the chart for Strategy Inc. for the last 12 months, what am I seeing?
You are seeing a sea of red.
Just red.
Just red. You are seeing a massive retreat from the highs. In late 2024, the stock was riding these speculative waves, trading well above $450 a share.
Right. It was pure euphoria then.
It was absolute euphoria. Everyone was calling for $1,000 a share. It was all over the news. Now, fast forward to early 2026, where we are now, and the stock is consolidating in the $160 range.
Ouch. From $450 to $160.
Yeah.
That is a painful, painful drop if you bought the top. That's more than a correction. That's a crash.
Oh, it is.
That is a rethinking your life choices kind of drop.
It is. And the market cap reflects that perfectly. It contracted from roughly $73.46 billion in January of 2025.
$73 billion.
Down to about $46.15 billion today.
Wow.
So you're talking about nearly $30 billion in paper value that just evaporated.
Gone.
So if you are looking at the traditional metrics, price, market cap, PE ratio, all that stuff, this looks like a company in steep decline. It looks like the bubble burst.
Right. And that is why they call it the lost year. They say, look, you lost money, the company is smaller, the experiment failed. But this is where the source material gets spicy.
Yes, it does.
It says this view is a superficial analysis. It calls the price chart an optical illusion.
That's the core argument right there. Michael Saylor, the executive chairman, and all the proponents of this refinery model, they argue that the stock price is just a nominal fiat number.
Just noise.
It's just noise. It fluctuates based on sentiment, fear, greed, premiums. But if you look at the underlying asset base, the actual stuff the company owns, it's a completely different story.
The stuff being Bitcoin.
Precisely. The stuff is Bitcoin. And while the stock price was tanking, the Bitcoin treasury was. It was exploding.
It wasn't just growing, it was exploding.
In that same 12-month period, Strategy Inc. didn't sell assets to survive. They didn't shrink their operations. They expanded their holdings by more than 265,000 Bitcoin.
Wait, let me repeat that number. 265,000 BTC.
In 1 year.
In 1 year.
That's unbelievable.
Yes. To put that in perspective for you, that is more than most sovereign nations hold. It's more than the U.S. government holds in seized assets. It's a staggering amount of structural growth. So the argument is, are you measuring the company by the fluctuating price tag the market puts on it today?
Which is based on fear and greed.
Or by the actual pile of digital gold in the vault?
Exactly. What do they actually own?
This is where that refinery analogy comes in, right? I love this visual because it completely changes the mental model.
It's so important.
We need to stop thinking of them as a software company that happens to own some Bitcoin.
Right. It's not a side hustle.
We need to think of them as a factory, a purpose-built factory.
A Bitcoin refinery. That's its function.
So walk me through this.
Yeah.
In a factory, you have inputs, you have a process, and you have outputs. What are the inputs of this refinery? What's the raw material?
Okay, so in a traditional oil refinery, you take crude oil, you refine it, you get gasoline.
Right.
In the Bitcoin refinery, the raw material is fiat currency. It's legacy capital.
Okay, so just dollars.
The company uses the capital markets, selling shares, selling debt, to literally suck in U.S. dollars.
They are vacuuming up fiat from the global financial system.
Exactly. And then they process those dollars through this sophisticated machinery of financial engineering, using the premium, using convertibles, using equity to produce a single high-quality product.
And that product is
It's a coin per share.
not just Bitcoin. Bitcoin per share.
That's the output. And that distinction is everything. The goal isn't just get more Bitcoin. The goal is get more Bitcoin per share.
We need to unpack that distinction because that is where the magic trick happens. That is the glitch.
That's the whole game.
But before we get to the glitch, let's look at the tail of the tape. I want to walk through the specific numbers from the source because they really highlight this divergence between price and actual value.
Let's do it. January 2025 versus January 2026. The numbers don't lie.
Okay, I have the table right here. Let's look at stock price first.
Yeah.
This is adjusted for any splits, of course.
Yeah.
Jan 2025.
Yeah.
$334.79.
$334.
Jan 2026. $161.58.
Wow.
That is a drop of 51.74%. It's literally half off.
Brutal for a short-term trader. I mean, if you needed that money for a down payment in 2025, you are hurting badly.
Absolutely. Now, market cap. Jan 2025, $73.46 billion. Jan 2026, $46.15 billion. That's down 37%.
Again, on paper, it just looks like a shrinking company. The market voted and the market said, you are worth less.
That's the story the chart tells. But now, let's look at the vault, the actual treasury, total Bitcoin holdings. Jan 2025, 447,470 BTC.
Okay.
Jan 2026, 712,647 BTC.
That's a huge jump.
That is up nearly 60%.
So wait, let me just process that. They grew the actual asset base by 60%, while the market cap dropped by 37%.
Yes.
That is a massive dislocation. That's a chasm between perception and reality.
It is.
It implies that the market is currently valuing the Bitcoin held by the company at a steep discount, or that market sentiment has just completely detached from the reality of the balance sheet.
But here's the number that matters most, because I can hear the skeptic in the audience right now.
Yeah.
They are saying, sure, they bought more Bitcoin, but they printed 1 billion shares to do it, so my slice of the pie is tiny now.
You diluted me to death. That's the classic complaint.
Exactly. So let's look at the dilution. Basic shares outstanding. It went from 245 million to 331 million.
Okay.
That's a 35% increase in the number of shares. That is massive dilution.
In a normal company, that would be shareholder destruction. If you dilute the shares by 45% and the company doesn't grow its earnings by at least 35%, the stock price collapses and the shareholders get crushed.
Your slice of the pizza got way, way smaller.
Right.
Exactly. But look at this final metric. This is the holy grail of this entire strategy, Bitcoin per share.
Okay.
And it's measured in Satoshis, the smallest unit of Bitcoin. Jan 2025, 158,826 sats per share.
Okay. 158,000.
Jan 2026, 195,689 sats per share.
Wow.
That is an increase of 23.21%.
And that is the mic drop statistic right there.
So let me just get this straight. The stock price went down 50%.
In half.
They printed 35% more shares.
Yep.
And yet, the amount of Bitcoin backing each one of those shares went up by 23%.
Correct. The fundamental unit of value, the actual Satoshi allocated to your share, increased substantially.
So even though the price the market is willing to pay for that, share went down.
The value inside the share, the actual claim on the treasury went up.
That feels like defying gravity. How do you print more shares but make each share worth more of the underlying asset?
Right.
Usually, printing shares dilutes the value. It seems almost too good to be true.
It does, but it's mathematically sound if you understand the premium. And this brings us perfectly to part 2 of our roadmap, the infinite money glitch.
I love that Saylor actually uses that term. It sounds like a cheat code in a video game.
Uh-huh.
Up, up, down, down, left, right, start. And suddenly you have infinite money. How does it work in the capital markets? Is it even legal?
It is perfectly legal, but it absolutely exploits a market inefficiency.
An arbitrage.
An arbitrage. It's all about the premium. It's about the difference between the net asset value, or NAV, the value of the Bitcoin Strategy Inc. actually owns, and the market price of Strategy Inc. stock.
Okay, let's use some really round, simple numbers to make this crystal clear for the listener.
Good idea.
Because understanding the premium is the key to understanding this entire business model. Without the premium, the model breaks, doesn't it?
It becomes much, much harder, yes. The premium is the fuel for the refinery.
Okay.
So imagine Strategy Inc. stock is trading at $160 per share today.
Okay, 160.
But if you take all their Bitcoin, find its market value, and divide it by the number of shares, you find that each share is only backed by, say, $120 worth of Bitcoin.
So I am paying $160 to buy something that only contains $120 worth of Bitcoin.
Exactly.
That sounds like a bad deal for me. Why would I do that? I'm instantly underwater on the asset.
It's a great question, and we will get to why you would do that in the scarcity arbitrage section. It has to do with access and liquidity and the bundle.
Okay, so we'll table that for a moment.
But for now, just accept that the market is paying that premium. Strategy Inc. sees this and says, okay, if you guys are willing to pay $160 for a piece of paper that's worth $120, we will print more paper.
So they issue a new share, they sell it to a frantic investor on the open market for $160 cash.
Right. Now they have $160 in the company bank account. What do?
They buy Bitcoin.
They turn around and buy Bitcoin with it. But remember, one share's worth of Bitcoin is only $120. So they take $120 of that new cash and they buy Bitcoin to back that new share they just created.
Okay, so the new guy's made whole, essentially. He has his $120 of backing.
He does, but they have $40 left over.
The surplus, the premium.
Exactly. They have a $40 surplus from capturing that market premium. And what do they do with that $40?
They buy more Bitcoin.
Yes. And here is the crucial part. Who does that extra Bitcoin belong to? It doesn't just belong to the new guy who bought the share. It gets distributed mathematically across all the shares. The new guy, the old guy, the guy who bought in 2020.
So everyone's share just got a little bit thicker with Bitcoin.
By selling equity at a premium, they are effectively capturing that extra value from the market and using it to thicken the Bitcoin density of every single share.
So dilution becomes accretion. It's the opposite of what's supposed to happen.
That is the alchemy. In a normal company, dilution buys you what? Operations, or it pays off debt, or maybe it buys a competitor, things that might generate value later on, maybe.
A lot of maybes.
Here, the dilution is directly and immediately used to buy the underlying asset at a rate that increases the asset per share ratio. It turns the logic of dilution completely on its head.
That is wild. It's essentially capturing the market's enthusiasm, the premium, and crystallizing it into hard assets. They are harvesting volatility.
That's a perfect way to put it. And they have been refining this process. The sources mention a capital structure optimization that happened in this last year. It wasn't just about blindly buying coin. It was about de-risking the entire machine. Because if you just leverage up to buy a volatile asset, you can get wiped out in a downturn.
Yeah, I saw that in the notes. They moved away from convertible debt. I thought that was their bread and butter for a while.
They are still using it, but there was a distinct and very strategic shift toward perpetual preferred equity.
Okay, explain that to me like I'm 5.
Yeah.
Or, okay, maybe like I'm a freshman finance major. Why does that switch from debt to preferred equity matter so much?
Convertible debt is great because it's cheap capital, but it has a maturity date. It's a ticking clock.
Right.
Eventually, in 5 or 7 years, you have to pay it back or convert it into shares. It creates pressure. If the Bitcoin price happens to be down when that debt comes due, you could be in a world of trouble.
Right, a liquidity crisis. You have to sell your assets at the bottom of the market just to pay the bank back.
The worst case scenario. Now, preferred equity is different. It's equity. It doesn't have a maturity date. It can sit on the balance sheet forever unless the company decides to redeem it. It pays a dividend, sure, but it never comes due.
So it's more permanent capital. It's patient.
Exactly. It's durable capital. It removes that ticking clock. And at the same time, they also build up a massive cash reserve. The source mentions a $2.25 billion USD reserve.
Yeah, that surprised me. Why sit on that much cash if you are a Bitcoin company?
Right.
Why not buy more Bitcoin with it? Isn't holding cash like holding a melting ice cube, as Sailor always says? He hates cash.
It is, but you need that cash to service the machine. You have interest payments on the debt. You have the dividend payments on the preferred equity. By having a $2.25 billion buffer, they ensure that they never, ever have to be a forced seller of Bitcoin to meet their obligations.
That is the key. Rule number 1 of this game: never sell the corn.
Never sell the corn. If the Bitcoin price crashes to $20,000 next week, Strategy Inc. doesn't get margin called. They don't panic. They have the cash to pay the interest. They can ride out any storm.
And that's what happened this last year.
That's what happened. They built a fortress balance sheet.
So while the stock price was looking weak and vulnerable, the company was actually putting on armor. They were digging a moat and reinforcing the walls.
Exactly. They traded short-term price appreciation and market sentiment for long-term survivability. And for an investor looking at the next decade, that survivability is worth far more than a quarterly earnings pop.
This leads us to a deeper philosophical divide, doesn't it? This isn't just about math and finance. It's about what it even means to be an investor.
100%.
The source draws this really interesting comparison between investing in Strategy Inc. and investing in, say, Apple.
The investor versus the speculator. It's a classic distinction.
Yeah. Right. And usually we think of Apple investors as these serious investors with a capital I, and crypto people as the wild speculators. But the source completely flips this on its head.
It does, and it's a really compelling argument when you break it down. Think about a typical Apple investor. Why do you buy Apple stock? Be honest.
Because I want the price to go up. I want to sell it in 5 or 10 years for a profit. Or maybe I want the dividends. Ultimately, I want more fiat currency at the end of the day.
Right. But do you want to own the iPhone factories?
No.
If Apple shut down tomorrow, stopped selling phones, fired everyone, do you want them to ship you a pallet of unsold MacBooks and some conveyor belts from a factory in China?
God, no. What would I do with that? I have no use for a conveyor belt. I just want the fiat gain from the stock price.
Right. So fundamentally, you are speculating on the future cash flows and the market sentiment of that equity. You have no real interest in the physical assets of the company. You are renting the stock to get more dollars.
That's true. It's a means to an end. The end is more dollars.
Now look at the Strategy Inc. investor, the true believer, the MSTR Maxi. What is their end game? What do they want?
They want the Bitcoin. It's that simple.
Correct. They are focused on terminal value. The question they ask is not, what will the price be next quarter? But if this company turned off the lights tomorrow, fired everyone, and liquidated, what do I own?
I own a claim on the Bitcoin treasury. I own my pro rata share of 712,000 Bitcoin.
And because Bitcoin is a monetary asset, a global store of value, you are actually happy to own the underlying asset. You aren't hoping to sell the stock for fiat eventually. You are using the stock as a vessel to accumulate the asset.
It's a long as tall perspective.
Exactly. You believe Bitcoin will outlast Strategy Inc., that it will outlast Apple, and maybe that it will even outlast the US dollar itself.
That is a profound shift in thinking. It's almost like treating the stock as a warehouse receipt for a commodity.
It is. It transforms the stock market from a casino into a savings account. And this mindset shift changes how you look at something like radical transparency, too.
Yes. The Swords mentions this. Apple, for all its greatness, is opaque.
It's a black box.
Do you know how much cash Apple has right now this second? No. Do you know the exact value of their real estate holdings or their inventory this second? No.
It's all quarterly reports and estimates and footnotes. You trust the management to tell you the truth every 3 months. You rely on auditors, regulations, and frankly, a lot of faith.
But Strategy Inc. has a public dashboard. You can go online right now and know almost to the minute exactly how many Bitcoin they have. You can calculate the NAV on a napkin in a bar.
It's the difference between a black box and a glass box. Because the underlying asset is on a public blockchain, auditability is instant and constant. You don't need to trust the CFO's report. You can verify on the chain yourself.
And that builds a very specific kind of trust for a very specific kind of investor who values verification over reputation.
Exactly. It appeals to the don't trust, verify crowd, which is the core ethos of Bitcoin anyway.
But I have to play devil's advocate here for a minute.
Please do.
I can hear the critics screaming at their speakers right now. They always ask this. Why Bitcoin? If you want to be a treasury company, why not buy gold? Why not buy real estate? Why not buy commercial buildings in Manhattan? At least those produce cash flow?
Mm-hmm.
Why bet the entire farm on digital magic internet money?
It's a fair question. And the answer, according to the source material, is one word. Speed.
Speed.
The source calls it the velocity of capital.
Speed. How does speed translate to value in this context?
Okay, imagine you raise $1 billion on Wall Street this morning. You issue a bond. The money hits your account at 9:00 a.m.
I've got $1 billion.
You want to deploy it into Manhattan real estate. How long does that take?
Oh, man. Months. Maybe years. You have to find the buildings, do the due diligence, the inspections, negotiate with sellers, pay the lawyers, pay the realtors, wait for closing. It's a nightmare of friction.
Exactly. High friction, high transaction costs, opaque pricing. And during those 6 months or a year, Where is your $1 billion? It's sitting in cash, losing value to inflation every single day.
The melting ice cube?
The melting ice cube. Now, imagine you want to put that $1 billion into Bitcoin.
Click. Buy. Done.
Strategy Inc. has built the infrastructure where they can turn fresh capital into Bitcoin within an hour. The source states they can process transactions at a rate of $100 million per hour.
That is insane. $100 million an hour.
It means they can build the building in real time. As soon as the money comes in from the investors, it is hardened into the asset. There is no lag. There is no construction phase.
Wow.
This velocity allows them to react to the market instantly. If the premium is high at 10:00 a.m., they issue shares. By 2:00 p.m., that money is already Bitcoin in their treasury. You can't do that with apartment complexes or gold bars in a vault in London.
It's liquid digital energy versus frozen analog matter. It allows them to cycle the capital markets much, much faster than any traditional company could dream of.
That's a great way to put it. They are operating at a frequency that real estate developers can't even comprehend. It's high-frequency treasury management.
Okay, so we understand the glitch and the philosophy.
Yeah.
But we still have that big hanging question from earlier.
The premium.
Why pay the premium? If I can go buy Bitcoin on Coinbase for, in our example, $120, why would I pay MSTR $160 for it? We talked about the scarcity arbitrage. Let's really dig into that now.
This is the bundle theory. And it explains why the premium exists and why, for certain buyers, it might actually be rational.
Bundle, okay.
Strategy Inc. holds, as of January 2026, 712,647 Bitcoin.
712,000.
That is over 3.4% of the total supply that will ever exist.
That's a hoard. I mean, that is a dragon's hoard of Bitcoin.
It is. Now, imagine you are a large entity, maybe a sovereign wealth fund from the Middle East, maybe a tech giant like Google or Amazon, and your board decides, we're behind. We need to catch up. We need exposure. We want 700,000 Bitcoin on our balance sheet by next year.
Good luck with that.
You cannot buy it. It is not available for sale. If you went into the open market today and tried to place buy orders for 700,000 BTC, you would create a vertical line on the price chart.
You'd break the market.
You would push the price to $500,000, maybe $1 million per coin, just trying to fill your own order.
The slippage would be astronomical. You would blow up the market against yourself with every purchase.
Massive, massive slippage. The true availability of Bitcoin on exchanges is very low. Most of it is held by strong hands-HO dealers who aren't selling at current prices. So Strategy Inc. has already done the heavy lifting over years. They have already secured the block.
So when I buy MSTR stock, I am not just buying Bitcoin. I am buying a slice of a block that is otherwise impossible for me to replicate on my own.
Exactly. You are paying for the concentration. You are paying for the fact that this bundle exists, is secured, is audited, and is available in a regulated vehicle. It's like buying a finished collection of rare art. You pay more for the whole collection than the sum of the individual paintings because the act of assembling that collection again would be impossible. The time and the effort and the market impact to assemble it has value. That value is the premium.
And we've seen this play out in the real world, haven't we? With the ETFs.
We have empirical proof. It's not just a theory anymore. Remember when the spot ETFs launched a couple of years ago?
Of course.
They started hoarding Bitcoin. Not even 700,000 coins, but very significant amounts, day after day. What happened to the price?
It went from around 40K to over 120K very, very quickly.
Boom, a massive supply shock. So the market knows that accumulating size moves the price. Strategy Inc. allows you to own the size without having to move the price yourself. That convenience, that access, carries a premium.
That is the premium justification. But there is another angle here that the source material mentions, the asymmetry of capital flows.
Yes.
This is a bit technical, but I think it's crucial to understanding the long-term risk profile of this thing.
It's the inflow versus outflow dynamic. And it's really clever. Think about it. When Strategy Inc. buys Bitcoin, they act as a single massive entity. They create a supply shock. They drive the price up. That benefits all the existing shareholders.
Right. They are the whale-making waves that lift all boats.
Exactly. Now, what if Strategy Inc. disappears? What if they close up shop? This is the nightmare scenario the critics always bring up.
Right.
They say, if MSTR fails, they will dump 712,000 coins on the market and crash Bitcoin to zero.
People worry about that constantly. They call it the MSTR overhang.
But that's not how corporate liquidation works, especially not in this case. If MSTR were to dissolve, they wouldn't sell the Bitcoin for cash and then give you the dollars. Why would they do that? That incurs massive tax liabilities and market slippage.
So what would they do?
They would distribute the Bitcoin in kind to the shareholders.
Ah, so the Bitcoin just moves from the company wallet to my personal wallet.
Exactly. And who are the MSTR shareholders? We just established this. They are the longest haul believers. They are the ones who are in it for the terminal value.
They want the asset, not the fiat.
So if they receive the Bitcoin directly into their own custody, are they going to turn around and market dump it?
Probably not. They'll just HODL it personally, which is what
Yeah.
they wanted all along.
So the divestiture shock is muted. It's dissipated.
Wow.
Yes. The buying pressure is concentrated and explosive because MSTR buys aggressively. But the selling pressure, in a worst-case liquidation scenario, is diffuse and dampened because it goes directly to strong hands.
That asymmetry is incredibly valuable. You get the upside of the supply squeeze without the full downside of the dump.
It's like a one-way valve for capital pressure.
That is a fascinating way to look at risk. It completely turns the overhang fear into a bit of a ghost story.
It really does.
Okay, let's bring this all down to the bottom line. How do we measure success if stock price is an illusion and fiat is melting? If the dollar is losing value and stock prices are just noisy sentiment, what is the ruler? What is the actual yardstick? The source introduces a new KPI, a new key performance indicator for the 21st century.
Bitcoin yield.
Define it for us. What is it technically?
Bitcoin yield is the percentage change, period over period, in the ratio of total Bitcoin holdings to the assumed diluted shares outstanding.
Okay, now say that again in English.
Fair enough. It's simple. Is your slice of the Bitcoin pie getting bigger or smaller over time? That's it.
It's an efficiency metric.
It doesn't care about the dollar price of Bitcoin. It doesn't care about the dollar price of the stock. It only cares about one single thing. Do I, as a shareholder, own more Satoshis per share today than I did yesterday?
It measures how well the refinery is running. Is it efficiently converting fiat into Bitcoin per share?
Exactly. And the numbers for this supposed lost year are just incredible when you look at them through this lens.
Okay, what were they?
In 2024, the actual Bitcoin yield was 74.3%.
74%. That's insane growth.
Insane. Now, in 2025, a much tougher, choppier market, they initially targeted a 15% yield. Then they revised that target up to 30%.
Okay.
And as of the last report in October 2025, they were sitting at a 26% yield for the year.
So despite the chaotic market, despite the stock dropping in half, they generated a 26% yield in terms of hard assets for their shareholders.
Let me ask you this. If you could find a bank account that paid you 26% interest, not in dollars, but in physical gold bars,
I'd be all in.
would you care if the currency of the country the bank was in fluctuated against the euro or the yen?
No. I would just want the gold. Give me the metal.
That is the entire argument. In a world of constant fiat debasement, where the dollar is losing 10%, 15%, 20% of its purchasing power a year in real terms, earning a 26% yield in the hardest asset on earth is, well, it's the holy grail. It outperforms every hedge fund, every bond, every savings account on the planet.
It completely changes the definition of the lost year.
It wasn't lost at all. It was a year of intense foundation building. Let's just synthesize it.
Okay, let's recap.
Number one, they added 265,177 BTC to the treasury, a nearly 60% increase.
Huge.
Number two, they achieved a 26% plus Bitcoin yield, making every shareholder richer in Bitcoin terms.
Accretive dilution.
Number three, they swapped volatile short-term debt for permanent, durable equity, de-risking the balance sheet. And number four, they built a $2.25 billion cash wall to ensure they would never be a forced seller.
It sounds like they spent the year fortifying the castle while everyone else on Wall Street was complaining about the paint color on the outside walls.
That is exactly what happened. The market was looking at the paint, which is the stock price, and Saylor was reinforcing the foundation walls, which is the treasury.
So what does this all mean? If we zoom out from this one company, is Strategy Inc. a unicorn? Is it a one-off weird experiment? Or is this the first of a new species of corporation?
That is the provocative thought to leave with, isn't it? Is Strategy Inc. a new model for the corporation in the 21st century?
A model that prioritizes digital capital accumulation over everything else, over earnings, over dividends, over stock buybacks.
Think about it. For the last 100 years, corporations have been designed to maximize shareholder value, which has always been defined as the nominal stock price.
Right, make the number go up.
Strategy Inc. is trying to maximize shareholder assets, which they define as Bitcoin. It's a fundamental shift from nominal thinking, just counting dollars, to real thinking, counting hard assets.
And if they are right, if Bitcoin does become the global reserve asset that they think it will, then MSTR isn't just a software company. It isn't even just an investment fund.
It's a central bank.
It's a private sector central bank.
A decentralized central bank, or at least a commercial bank of the future. It forces us to ask, what is the true role of a company in an age of monetary debasement? Is it to generate cash flow in a dying currency, or is it to act as a vessel to carry purchasing power safely through time?
Deep stuff. And honestly, it's scary stuff if you are stuck in the old model. If your whole portfolio is cash and bonds, this logic is terrifying.
Indeed. It suggests that the old rules of finance aren't just bending, they are breaking.
Listen, we have covered a lot of ground today, from the optical illusion of the price chart to the deep mechanics of the infinite money glitch. But we know this is a polarizing topic. People either love this company and this strategy, or they think it's a giant Ponzi scheme waiting to collapse. There's not much middle ground.
Very, very polarizing.
So we want to hear from you. The analysis in this deep dive is based on publicly available information, but the story is unfolding every single day. Are we being too optimistic? Have we drunk the orange Kool-Aid?
Or, on the other side, are the critics just missing the forest for the trees? Are they stuck in 20th century evaluation models while the world is moving to a 21st century asset?
Tell us what you think in the comments. And we're always looking for collaborators, too. If you're a finance expert, a CPA, or a crypto native who spotted a detail we missed or a risk we understated, please reach out. We want to refine our own refinery of knowledge.
We need your inputs to improve our outputs.
Nice callback. All right, everyone, thank you for diving deep with us today. Please don't forget to hit that subscribe button. Help us get to 1,000 so we can unlock that Mosaic AI video editor.
And check out the STRC course in the description if you need to calm your nerves after all this volatility talk.
Yes, definitely. And remember,
price is what you pay. Value is what you get.
As always, keep searching. Keep the quest on.
See you in the next deep dive.
I'm Satosha.
And I'm Satoshi.